Episode 3 of our passive income series, where I'm joined by experienced financial planners being plural. Drew, welcome back to Selfwealth Live, mate.
It's good to be back.
Yeah, it's always a bit of fun, and we're particularly satisfied today because we get to spend some time with Jamie Nemtsas. How you going, mate?
Yeah, great.
We are, as you will know, if you've been tuning into the first 2 episodes or you have tuned in, we are talking purely about passive income. But we're tilting it today to talk about a typical scenario that might apply to a couple, in this case, that are approaching retirement and are interested in passive income because they're worried about, switching off the tap of income and salary that people do. And I know you guys have a lot of experience with this. But Jamie, maybe just to throw it over to you quickly, for folks that haven't heard from you on the Selfwealth Live program, can you tell us a little bit about yourself? And then maybe also about Wattle Partners itself. We heard a bit from Drew last week, but
Sure.
tell us a little bit about Jamie Nemtsas and what you do.
I'm essentially the other half of Wattle Partners, so Drew's business partner. I'm 47, been a financial planner for 25 years. So when I was 22, it was the first job I had, and still now.
Yep.
Wattle Partners, I joined soon after. It had a different name back then, but essentially the firm was has its origins 50 years, 1973, and was always an advocate for independent fee-for-service investment advice. It was that firm that I met Drew, and now we're partners. We always had the same values in terms of what we think good advice is, and have built, and enjoy running our firm in Melbourne. We do have clients all over Australia, so it's not essentially just a Melbourne orientated firm. Of course, we used to travel a lot, travel a bit less now, and digital has helped us. So Zoom and podcasts and market updates are a lot easier to service clients. But typically our clients are plus 60. We do have a handful of accumulators, but typically plus 60, and we specialise in that period, 60 to 90, essentially the last trimester or the third trimester of your life, and it takes we've developed kind of unique skills, not just in investments but also in life, that it takes to be a good advisor over that.
Yeah, absolutely. And I think it's so great that you can say the firm has been, it has its origins from such a long time ago. For the folks that don't tune into the podcasts that we regularly do, I said this to you the other day, but whenever someone listens to you on the podcast, and Drew's going to smile when I say this, they always come away and say, Jamie was brilliant. So
it's lots of pressure.
Tough act to follow, mate.
I'll strive for that because it really annoys Drew. So.
I think it's pretty unique too to have 2 partners that kind of work on every person that comes in, and 2 completely different kind of people and different backgrounds. So I think
we actually share offices, so it's it's constant. So there'll be a client on a Zoom call, and Drew's head will pop over and mention and comment stuff, and 2 different strengths, and we're surrounded by phenomenal people within our business. There's about 40 people on the floor, and they all have different inputs, and it's quite a not a hierarchy type business where everyone's view is listened to and articulated. So clients are getting a lot of access.
Yeah, absolutely they are. Okay, so we're going to post the scenario that I've given to these guys in the description of the video. So if you wanted to pause right now, you could, and you could just have a quick glance through that. But typically what happens in a financial planning situation is a client would present to a financial planner. There'll be something called a fact find, which is basically where you submit all your information. There'll be a risk profile, and oftentimes there's like an introductory call and a get to know you type thing. So I've included basically how someone would present to financial planners like Jamie and Drew here. And I won't go through everything right now, but I will just make an introduction. So we've got Cathie, who is 57 years old, and Wood, who is 61. They currently live in Ashmore in Queensland, which, if you guys don't know, is a very lovely part of Queensland. They've got a 4-bedroom, 2-bathroom house. Wood is a physio, earning $120,000. He loves the Brisbane Lions. And in the AFL, of course, we are Victorian, and spends his weekend watching their 2 boys play sport. Cathie is a software engineer who works 7 days of night shift every fortnight as overnight support for a global technology company. She earns $135,000. Now, I won't go through it all line by line because I would encourage you to read that, but I'm just going to draw out some of the major things in the financial picture here. We've got Wood's superannuation, which is $350K. Cathie's is $460. They have the house in Ashmore, which I've speculated is worth $1.5 million. They've got an investment portfolio of $210K. They still have a mortgage on that. They've got a little bit of a credit card. That their two boys are 17 and 19. They estimate their current expenses. This is something that I imagine not many clients have a firm grasp on, but just kind of generally speaking, is around $6,000 per month or $72,000 a year. They say that they have adequate insurance held inside super. Wood is an only child and could be expected to inherit $300,000 in 5 years. So already we're getting a situation here where they seem to have done quite well for themselves, but there are some things that they're unsure about. There are a few questions that we have here, but the big one is, and given that this is for passive income, they're hoping to earn between $70,000 and $80,000 in today's income, so today's dollars, because they are really worried about what happens when they hit retirement and they clock off essentially for the last time. They both want to retire between 64 and 67, debt-free ideally, which I think they should be able to do. They don't want to move straight away or sell their house, but would be open to downsizing for retirement once the kids have moved out. Wood says is growth focused. Cathie says she's a lower risk investor. So there's two different risk profiles in the mix here, which I imagine is quite common. Cathie and Wood would like to spend 4 weeks per year on holiday, either locally or internationally after they turn 60. Who wouldn't? I'm sure we'll get to that, Jamie, in just a second. And Cathie would like to build wealth outside of super in the house, whereas Wood likes the tax-advantaged status of super. So, maybe Drew, we'll start with you.
It looks a lot like a lot of emails we'd get and clients reaching out on a regular basis where you kind of get a random email come through. There's a little bit of information.
Yeah, right.
But not the whole case.
So they would just email you.
Yeah, a lot of the time.
They see that you're a financial planner and they'd be like, okay, this is
probably not to some of the detail, but broadly, this is what we do. This is what we've got.
Yeah.
Can you help us?
There's a paper called a fact finder that is used within financial planning. It's a way to collect data. We would send that out to a client and ask them to fill it in, but initial conversations, any format that is a summary of your financial position helps. So if you're prepared to write an email like this to us, then that's probably 80%. And then if our advice goes further, then essentially we'll seek more information.
Okay. So in the last installment of Selfwealth Live, we talked about different things to invest in.
Yep.
People will remember some of the shares and the funds and the ETFs that we talked about.
Yep.
But I'd imagine there's a lot of your work goes before that. So can you maybe talk to us, how do you go from this? So Jamie mentioned a fact finder. How do you go from this through to implementing a portfolio or helping them invest?
Yeah, I think it's investments are traditionally where people focus all their time and attention. But this example is probably perfect in terms of retirement where they haven't thought about retirement and they're 61. It's common to so many people. They just completely kind of focus on their work, life, children, and then it turns to retirement. The process is fairly straightforward. Something will reach out. Someone will either pick up an email or something, and there will initially be a phone call to introduce ourselves and to kind of broadly explain the process. And the most important part is the getting to know you process, which Jamie was referring to, where you will send a client questionnaire that asks for this to be detailed more formally. And obviously you can't provide any level of personal advice until you know significantly more about that person as well. So
you can't give any type of guidance until they've given you their risk profile and their fact find.
Yep. So you can provide general information. So we could explain
kind of like this
tax benefits, super, video. Exactly.
Yep.
Why you'd use super.
Yep.
What the risk of investments are, what the contribution limits are, but never what that person should specifically do.
Yeah, right.
So investments aside, it's about strategy.
Yeah.
And, so this is a formation. When we see this, it's kind of we start thinking about Are their objectives in line with their portfolio? Does the risk profile speak to getting to where they want to get to? Are they telling you the truth? Because it's easy not to tell you the truth here. What needs to be done? Are they willing to do that to achieve their objectives? So strategy is the most important. Strategy 20 years ago used to be at an enormous amount of value. Now it adds a lot of value because there's less tricks of the trade. The industry is a lot cleaner and clearer than it was. But still, for me, it would be strategy. What are we going to do? How are we going to do it? And what do we need the clients to accept that they need to do? So this is a two-way process, right? We're essentially a partnership with our clients. We're saying, well, if you really want $80,000 a year, then how much capital we think you need this amount of capital. Yeah. So how are we going to get to that level of capital?
Would you say that $80,000 is for, in this case, a couple? Would you say that's typical for some people?
We had a better grip of this pre the inflation spike for the last 18 months. But it's probably what people spend in retirement is 80 as a basic level.
Okay.
So let's exclude offshore trips. Let's exclude improving the house.
Renos and that sort of stuff.
New car. Yeah. Giving money to children.
To more one-offs.
Probably if we took our client base and stripped it down, it's probably around that $80,000 mark.
70 to 80K basic expenses, basic going out.
Yeah.
Which is a bit higher than most of the reporting would say. It's like 50 or so.
60,
but in real life, it's probably significantly higher.
Yeah. We better rather over budget, I guess, for it if you can. Okay. So just one more question on the financial planning process, because I know a lot of people that watch Selfwealth Live have never been through this process, but also kind of don't really maybe have an exact understanding of how it works. When you see clients as a financial planner, do most of them make it through that, as you said, Jamie, before, the two-way process? Do they make it through that, or do a lot of them drop off because there's differences, or like, I guess it's just a sense of like getting through that process to becoming a client?
Yeah, it's a really good question, and we're actually talking about it this morning. So Drew and I have got certain personalities, and we've set up our business in a certain way. So therefore, we have to find clients that want that advice, right? That want this long-term partnership, trusted partnership that will be there through their whole retirement. So it's really important that the client matches the kind of attributes and the values and the goals that Drew and I and our firm have. I think that comes up pretty early, the way we represent ourselves here, the way we represent ourselves in the market, how we are really frank, saying, hey, we're not taking any fees behind any counters. We're saying you need to pay us. Every dollar that we get comes from you, and we want to be paid for our time and our strategy, and this is what it looks like. To answer your question, I'm avoiding the answering the question, but avoiding your question, there's a funnel. People come and meet us. Some drop off, some don't. We go, well, there's a lot of clients. If you think about our client base, it's about 200 clients. If you think about people that call us their advisor, it's probably 500 or 600 because people have come to us and we've said, listen, this is what you should do. You've got a certain amount of money. Sit down with us for an hour. We'll write you a strategy report known as a financial plan. Execute it yourself. Come and see us in 5 years' time, or give us a call if there's a problem. So that might be a strategy that involves an industry superannuation fund, or it might be their own portfolio, or heavily into real estate or something else. So we don't essentially engage them on an ongoing portfolio management, but we've provided the strategy, which you can argue creates a lot of value.
Yeah.
So
I think the challenge in financial advice is advisors want to help everyone, and we've talked about it regularly as well. But there's only a certain, there's only a certain number of people you can help, and there's certain areas where we have worked out we can add value and where we have significant expertise. And that's that retirement story, but also the strategy around retirement and all the parts that come to that. So, and there's specific parts of advice like insurance, and it could be, age pension and those, but where real experience is needed to get the best out of those for different types of people.
Yeah.
And we wouldn't do that. So we don't do insurance. We don't necessarily do. And when we say we don't do, it doesn't mean we don't have an opinion.
Yeah.
So we have an opinion. I think one of the things, and probably a different podcast, The thing that people don't get advice on or have a strategy around is home loans, and if it's variable or fixed, and when to variable and fix it. It's probably one of the things that create and destroys wealth quite quickly, but people don't get advice around it.
Yeah.
So we have opinions on it, but we wouldn't advise people on which mortgage to buy.
Yeah.
We wouldn't advise people on which insurance fund they should have. We know what is a good contingency pool provided by insurance. So, but our expertise is really 50 plus or someone with a substantial pool of capital.
You think about the same way as medicine or any other profession where you're just specialising in a certain area, whether it's law or...
whatever, engineering,
Yeah.
So just to confirm then, so you mentioned there, Jamie, about some clients come to you and they might still use Selfwealth, which I've got on the screen here in front of me. They might still use their brokerage to buy these income stocks and these ETFs and the funds that they can buy through the platform. But then there are other clients who don't want that. They just want hands off, like you manage it for me. They push it across the desk to you guys. So that's like full implementation. You guys manage it, you report to them. And then there's the other clients who just want the structure and you say, go and do this. This is our expert advice, but come back in 5 years when you're ready.
Yep. Or do these things. So it might be pay off your credit cards, sell your investments, sell your investments, pay down your non-deductible loan, buy them back, do A, B, C, and D. Here's our strategy work, which is a paper. Take it away and execute it. Have any problems, give us a call. We'll charge you on an hourly basis if you've got a problem. Yep. And then check in with us when there's a major event in your life, so whatever that might be, and then come back to us for another check, and we might write another strategy document in 5 years' time. So
a lot of that's clients referring, like 60 or 70-year-old clients referring their children. It becomes a starting point as well.
Sure.
Yeah.
Well, we have multi-generation, right? So we're clients in their late 80s recommending their clients, their children that are in their 60s that are recommending their clients that are in their children that are in their 30s. So.
That's great.
We're pretty big on making sure strategy and investments are separated constantly. I think you're going to ask us about free kicks.
Yeah.
There's a lot of free kicks and cost savings just in the strategy side, but so many people go straight to the investments.
Yeah, absolutely they do.
And where all of our documents are split, completely separate between the two.
So I can see, so with this, if we come back towards the case study, so we can see in this portfolio from Cathie and Wood that they've got their house, which is clearly their biggest gross asset. And then they've got, $800K or so in super. But then they've got this $200,000 or so in some listed investment companies. They've got a Magellan ETF, BHP shares, CBA shares, and some ETFs. It kind of looks like, in my opinion, that it would be almost like that structuring piece would tidy up a lot of that and give them that intention, like the focus to move forward. But rather than take some words out of your mouth, perhaps.
Sure. I mean, I think that's what Drew's saying. There's not enough information here. We don't see, when we see this, we don't see BHP, CBA. We don't see that initially, right? We just think about, well, what does it look like? And you go, well, they've got a mortgage, but they've got capital. Is that tax deductible or not? Doesn't provide that or not?
Yep.
Is there any capital gains tax on those investments? And if there isn't, maybe we sell them all, pay off the loan, relook at that loan, borrow it back. Maybe they go into if you're going to borrow against your house for accumulation, we're not the experts in that, but I'd assume that you don't want specific investment risk. So you might go broader with your approach, like an index or ETF index versus going, I'm going to have a bet on what CBA is going to do. Yeah. So we would do that.
Yeah.
That getting to know you process is all about finding essentially red flags. Are there things that they're saying that don't match? Like they've said they're saving how much per month, but is that actually shown in how much their savings account has gone up? You find out those things pretty quickly. And then there'd be a series 10 to 15 additional questions that you'd ask in person. So the client questionnaire is just a starting point, same as a risk profile.
Yep.
You need to understand why people, I think you said one's more risk averse than the other.
Yep.
Why is that? Is it a lack of understanding or is it actually bad experiences
or control?
Right. Okay, so I am going to ask you for these free kicks or easy wins here. I've asked for a couple. If you don't mind, feel free maybe Drew, we'll start with you, and then Jamie will share if he's got any as well.
This is probably a good one because we'll probably have different ones.
Yeah, okay.
I think.
So like,
if we're not sharing notes.
yeah, if you're not sharing notes. Drew's got his computer in front of him.
Sure,
I'll
that's
take
an AI bot.
ChatGPT. I just took the first one, which will be easy. It looks like in the scenario they had cash and term deposits, not in their offset account.
Yeah, true.
I'm not sure what the purpose of that is. So, so the offset accounts obviously reduce the interest you're charged on your mortgage. And if we make the assumption that it's not for investment purposes, then it's not deductible.
Yep.
Then it would make complete sense to move cash and term deposits, which would be yielding maybe 2 to 3% on average into the mortgage, because the mortgage rate's probably 5%. But the cost, the effective rate of return by reducing the interest is actually you'd say it's the after cost tax of that interest.
They might even pay off their credit cards first.
Yeah.
Because they've got $18,000 worth of credit cards, even though they say they're spending $6,000 a month.
That's a red flag.
Yeah, so that would be so that's a red flag. That's an example of where they say they're doing one thing, but maybe there's some other skeleton here that's falling out of the closet.
And if we could use our experience and say there's two things that people generally don't tell the truth around, or don't know, or misguided: how much they spend, and everyone thinks they spend a lot less, and also portfolio returns. If you ask most people, they go, listen, my portfolio, because I manage it myself, has done 10% a year for the last 8 years.
Yep.
The truth of it is they don't know. They perceive it as 10%. Once you start tracking that, backtracking it, what we've found historically is it's nothing like 10%. So those two things, they're pretty important to get right within a investment process or trying to manage retirement money, is how much do you spend and how much potentially can you earn?
Yeah. I think like a lot of this, like even just this brief email example here, just is a great thought exercise for a lot of folks. Just sending an email to the financial planner will probably make you better with money because you're actually looking at it.
Yep.
Right. So they've got that small credit card there, 18,000. You've made the question about it being paid off every month. How about like the mortgage itself? You mentioned like that they say they want to be debt free, but they have an investment portfolio. Would you consider even paying off more of the mortgage? Because it's non-tax deductible debt, as you were saying, Jamie.
And then we probably have different views on this. Or there are two schools of thought. One would be, why are you holding assets that are volatile and don't offer a guaranteed rate of return, like just shares and ETFs, when you could be guaranteeing your return by reducing your mortgage?
Yep.
Yeah, I mean,
you provide the counter to that.
I probably can't. I think that this couple has come in and said, hey, we've got a specific objective. And they really have a date in mind. It looks like 5 years from now they want to retire.
Yep.
And everyone, we're taught and to think about retirement from the day we start. So when you're 20-year-old, you start watching podcasts about I retired at 30, I retired at 40, I retired at 50, right? So when you get there, it's quite an emotional state. And you think about retirement as a short-term exercise, but it's not. It's 30 years. Average couple, this couple, probably the life expectancy, the female being younger than the male, the female having a life expectancy longer than the male, they're looking at 30 years. So essentially, you're not just planning for $80,000 in year 1, 2, and 3 in 5 years' time.
Yeah.
It has to run for 30 years. And you've got a finite level of capital, which scares a lot of people.
I remember you said you would find that pretty scary too, that process.
Absolutely, whatever the number is. And it doesn't mean a low balance is scary.
Yeah.
A lot of people with high balances are scared
because,
market volatility, more money you have in markets, the bigger volatility. If you measure losses by dollars and not percentages, if you've got an $8 million portfolio and market drops 20%, that ends up being as much as you probably earned for 10 years. In your job historically. So, you can get yourself, but retirement needs to be approached just not from an investment perspective, but from a psychological perspective, and go that Drew talks about the seven stages in retirement. I think a bit more simply. I think about three stages in retirement. In the first 10 years, So I divide into 3, right? So 30 years, 10 years each. The first 10 years, typically this couple, I would say, would spend more than $80,000. So you've built...
Well, a holiday overseas is going to cost a bit, right?
Correct. They've got a new car at the moment because they've got a loan, but they probably need a car. A lot of people, probably 1 in 3, would you say, Drew, buy a four-wheel drive in a caravan, go around Australia at least once or
fix
twice.
a kitchen, bathroom. Something gets annoying when you're at home more often.
You've got children in that peak period where they need, the bank of mum and dad, so they need help getting into the property market. So this period between when they're, say, 65, first 10 years, is quite expensive, and you're pretty fit and active, so you want to do things,
spend
right?
it.
Yeah. The next 10
and you
years,
should.
Yeah, you should do it, right?
That's a time when it's easy to travel.
Yeah.
We encourage people to spend money in that 10 years. It's kind of, the apex of what everyone has built up. The next 10 years is more classical retirement. Essentially you move a little bit less. Your children are already established. You've done your overseas travel. You don't want to drive a four-wheel drive and caravan around Australia.
You're busy babysitting.
Yeah. Unfortunately, you then typically become or have you potentially become unwell. There's illness there. Doesn't mean it's fatal, but there's illness. So your movement is less. A large portion of people will lose a partner in that period of time. And then you've got the last 10. And then lots of things change in that last 10. We do a lot of work with that audience. Our average client is actually nearly 74 years of age. So we've got a lot of clients in that last third, and you're doing things like helping them sell down their principal residence, going into aged care, thinking about how the money is distributed to children, making sure
estate planning.
Estate planning is really important, educating the children and holding the children's hands about what that means. We're doing things for clients like organising extra support at their aged care facility. So if you think about 3 years, 3 periods of retirement, what does that mean? And you're spending, this is most important about spending, it's not going to be linear. So, and most financial planners will give you a chart and it'll go 80 and it'll go like this.
Yeah.
But that's
increasing by inflation too.
Yeah, that's not the case. So
I always got a bit of the heebie-jeebies when I thought about it. Look at those charts and they just assume everything just goes on into infinity.
So I think, and the role of an advisor, when you think about it, is actually to increase or maximize the probability that you can achieve that.
Yeah.
However that is, whether it's reducing risk, whether it's aligning, whether it's the free kicks, it's about probabilities.
Yeah. Before we move on, are there any other free kicks that you get from this scenario? Like,
looking at their superannuation, so you've just got superannuation that could be in a corporate fund that could be positive or really negative. It could be an industry fund that's the same. It could be a really slick self-managed superannuation fund they're running, or it could be a really messed up self-managed super fund that an accountant set up 15 years ago.
Direct
and it's
property or something.
still sitting in cash.
Yeah.
So there's a bit to unfold there.
And worth mentioning, I think it was the SMSF Association, didn't they? Came out and said the SMSFs can be tax cost effective and performance effective from 250. Noting that it would have to be suited to they'd have to obviously want control over their investments for that to make sense.
Yeah. Would most clients that you deal with have SMSFs?
Majority would have them before they come to us. Some would have a family trust. A lot of either business owners or professionals in some way. So
SMSF, just for the jargon buster here, is a self-managed super fund. Jamie mentioned retail fund being corporate. And
something like Qantas,
Telstra, etc. Whereas an industry fund would be like Australian Super or Host Plus or something like that. Do a lot of them?
Our client base is quite a unique client base. So we would say 70%, and what Drew's alluding to is because we essentially acquire clients in the age of 55 plus, they have they also have strategies that have been set up beforehand.
Yeah. Right.
So in terms of, if your question is, do we open a lot of self-managed super funds? We probably open as many super funds as we close. And self-managed super funds, which is not a known thing, are harder to close down than they are to open. And to open one,
significantly.
Open one within a week and you've got your own self-managed super fund. To close one, would still about a year, and then some crazy document will pop up in 18 months, it says, here's a check for $422 to your self-managed super fund and is now closed.
But you can't deposit.
Deal with that, Jamie. So I think strategy, they're a really interesting tool, and they're appropriate for a lot of clients. Some clients, there's better alternatives as the landscape for investments change, platform costs change, self-directed services change, then the cost comparison and the availability of investments increase. Then we go, and if you're a couple versus a single, the most appropriate strategy will include the most appropriate product. So
you can see that more people are beginning to engage. Like I think the biggest biggest cohort of people opening SMSFs were younger women from memory.
Yeah, it is, yeah. Which I was so surprised about that.
Yeah.
That women are more like... Yeah, I think it's fantastic. Yeah, and that's particularly in that accumulation phase. Women are opening SMSFs and taking control, it seems, which is fantastic.
People want control. They want to be able to, determine if investments align with what... Like the problem with default super is that you don't know whether those investments align with... And that's part of what an advisor will do. Do I have concerns about fossil fuel? Do I have concerns about nuclear energy? And making sure you're not investing in issues that you don't want to be in.
Did you see the Selfwealth report in Fin Review yesterday saying that the most traded demographics of people on their platform were 17-year-old males with an average of 60 trades? So,
oh, really?
So not saying that's the kind of changing dynamics of who controls these decisions. It used to be very male dominated, and we've been a part. The founder of our business also founded the Australian Investors Association. So Drew and I have been a part of the Australian Investors Association for a good 20 years. Well, I've been 20 years. So, you've seen control typically sit with the male. One of the problems I alluded to before is the male is somewhere between 5 to 7 years older than the female. And typically life expectancy is another 5 to 7 years. So you've got somewhere between 12 to 14 years that the female is going to live more than the male. And if the decision making just sits with a dominant male and they pass away, and typically when you pass away, it's sudden, right? Yeah. You don't get to prepare. You're alive, and we see it all the time. We're alive and then dead. Then who's going to look after the spouse that doesn't have the financial education that they need? So our client base does have a lot of preference to female, not a preference, but a bias to female. And females make great investors if they are provided with the education and the knowledge. They always want to know the why. Men typically want to know the return. So.
Yeah. Well, you see that a lot of the studies. Sorry, fellas. So we're saying this is three blokes sitting here. The ladies tend to beat us out when it comes to returns. So and there are many reasons for that. Just before we move on from super, and we will just caution, or I'll just caution to say that we're not advocating for or against one in super option or another. It's really important that you get advice on that because it is a major decision for a lot of folks. And also there are other implications that come with super funds like insurance, whether or not you have that cover in there, as well as tax.
And we would always compare those in a statement of advice, which would be the next part of that process. Once you've met and got to know someone, you'd compare their current fund to what we think would be the best fund for them.
So I've just got a couple of questions on this. Maybe for Cathie, would you consider, she's got 460K in super, which is great. Would you consider building that super balance or investing outside of super? Or you could say maybe for both of them if you want to take it in tandem.
The preference would be superannuation. Sounds like Cathie probably wants some access to control. So a lot of people get mixed up between access or control and what structure they want to hold. So not knowing, again, very general advice, but not knowing where their superannuation is at the moment, one of the things we would encourage is for these people to be to be educated over the next 5 years, and a self-managed super fund might help that exercise. So they've got a substantial balance in superannuation. And by bringing Cathie within the process of how we allocate investments, what do they look like, what's the characteristics, seeing the reporting, then she might feel more comfortable. Why superannuation? Well, it's the most tax-effective entity structure.
The biggest free kick you can get.
tax-free, right? So
Yep.
if you think about if I'm getting taxed at 30%, Drew's getting taxed at 0%, and then we want to get the same return, then I have to take substantial more risk than Drew to get the same return.
Because the tax rate's high. Yeah.
Yeah.
It's quite common, but people haven't engaged with their super until they hit retirement.
Yeah.
And it's a lot of it is about education. There's very few reasons, particularly when you're at 60 and you met your preservation age means you can start to access super under certain conditions. It makes complete sense to be focusing on superannuation, even if you decide to pull it out to pay off your mortgage when you actually retire.
Yeah.
The tax benefit's just too significant.
I find it's interesting that you mentioned that they don't really touch it until they get to a certain point. I find once they do engage with a financial planner or once they hit retirement, it's every single day.
Yeah, exactly. That's the balance.
Yeah,
absolutely.
They have to look at it every day.
There was an email that came in this morning that referenced financial advisors not being magicians, because that's from that old cartoon. I think we might have that printed in the office, where someone walks like similar to this. They walk in at 60, have no planning, and say, "All right, get me $100,000 a year.
Yeah. Here's what I got. Yeah. Figure it out."
That's right, because a lot of times they don't, like, you can see how their objectives, you can see how this scenario works, right?
Yeah.
So do all the magic. We'll get to retirement with somewhere between $1.5 to $2 million. We invest that properly, and we talk about what we think that is and having good cash buffers and acknowledging it. They're going to be okay. But a lot of people that come to us, it probably relates to what we were saying before, how many people fall off the process because they've got unrealistic expectations. So they're saying, hey, we actually need to live on $200,000 a year. We've started this process 4 years out. We only have $800,000. What do you think? I know you can get 10% on income on some investments. So, we think we've got enough. And then we're also in a business relationship, right? So we have to balance this. Hey, you're in crisis here. You've got to sell your house down and move out of the city and provide real advice, which is emotional, plus trying to keep a commercial relationship saying, hey, we want to be your advisor. And then essentially you want to keep a client for as long as possible. So when do you pull up stumps when they're not executing what they need?
There's probably a big challenge of advice that you don't want your advisor to be a yes person. Like, you also don't want them to be a no person. Like, it has to be a balance. There's a tendency to say yes, yes, yes. Oh, yes, you can spend the extra. Yes, you want your advisor to occasionally tell you no. So
I wrote an article about that being the biggest conflict in advice is saying yes. Because, if a client comes in and we've seen, we've worked in, this firm has been bigger and smaller and we've seen advisors that have just been yes people. So it's nice to go and see your advisor. You get breakfast in the morning, see the advisor and you see your clients going, can we go overseas to the advisor? And you go, well, actually, you said you want to live on $80,000, you're at $79,500 and you're saying you want to spend $50,000. The answer is no, but we also want you to be a client next year and a year after and a year after. So for me as an advisor, or let's not put it on me, let's put it on the other advisor, it's easy for him to say yes because nice warm feeling. You've seen a coffee client or breakfast, bang, client's happy, we get another year of fees or 2 years of fees. So to actually be a real advisor, you've got to be critical. And a lot of times you get into family situations where there's family pressure. Yeah,
it might not be a holiday, it might be a family
loan or a...
Yeah. And our client, we protect our client, right? So that typically is the parent. And, what does I want to borrow money? Well, it needs to be in a loan agreement. I want to do this. What does that look like? Is it fair across the three, if it's 3 children? So it gets quite conflicting and emotional. So we would get calls saying, you can't tell my mum that she can't loan money unless it's on a loan agreement because that would mean, there is so much more in financial planning than there is in, then it's just investments. We love investments. We live and breathe them. But, good financial planning. I saw a good post the other day on LinkedIn and then I came and talked to Drew about it. It said, what did you do today as a financial planner? And, most people would think, I bought an investment, sold an investment, or I thought about my asset allocation. But when you think about your day, we'll go and see a client at an aged care facility, make sure he's okay, hold a hand of a client because her husband has died at a funeral, work out how, so it's totally different than you might imagine that a financial planner is doing. Sure, we do investments within that day.
Buying and selling stocks.
Yeah, we do all that stuff, but there's all these other elements that we do on a daily basis. It's not really recognised, I think, and but clients value phenomenally. Yeah. So you wouldn't necessarily see those activities in our brochure. Not that we have a brochure, but website or whatever it might be. But it's definitely a part of our relationship. Right?
Yeah. So a question. I'm just going to ask you to put on a different hat really quickly, and imagine you have a younger demographic. So I'm 32. Imagine you've got someone in their 30s and early part of their 40s. They're thinking, well, I want to retire before I can access my super. Do you encourage younger people to accumulate wealth inside super as well? Like, should that be their default, or should they be exploring outside of super as well, like buying, holding ETFs or that sort of stuff as well?
1/3, 2/3 typically is the rule.
So what do you mean by that?
1/3, 2/3 in superannuation, 1/3 out. Okay. If we talk about accumulation, again, we talked about accumulation. Then it depends if you include your house or not, right? So if you include your house, then obviously it's different.
Most of it's outside, yeah.
But accumulation we've got views on as well. I think life is pretty easy as long as you don't make mistakes, but 80% of us make mistakes. So therefore, how do you keep people on the straight and narrow throughout accumulation? And if you think about, I know this is not about accumulation, but if you think about it, you never really see a big pool of capital. And that's why there's so many people that are subscribed to your podcast that want to know about investments, but they're 55 or 60 or 65 because you never really see pools of capital to invest. So a generic lifestyle cycle of a person is, get a job, find someone to partner up with, save up for a wedding that you spend too much money on. 2-3 years later, you've got a deposit for a house. Finally, you've got a massive debt over your head. Then children come along, so you're down to one income.
Interest rates go up.
So then you make sure you're living a great life. Don't.
Yeah.
But then
don't put people up.
You're putting a bit of money in superannuation. You're starting. Your children are gone. Your wife's gone back to work on a part-time basis. Then children probably need to be educated. So you're paying off your mortgage and educating them. And then it's not until probably 50s that you've got free cash flow to put away. Then you realise that, hey, retirement's not far away, so I'm just going to keep contributing to my superannuation fund, keep working really hard, still supporting my children. You get to 60, 65 and your 2 superannuation funds are there and inheritance has dropped as well, and bang, you've got $2 million and you've never really bought or sold shares. You've never really thought about it too much because not a lot of people have excess income, excess savings to the point where they go, should we put money in super or outside super?
Without other priorities, which is the big one.
Yeah. And we're not saying that's right or wrong, but that's the generic life cycle of people. Yeah. And if through that period they haven't done anything wrong, most people end up all right. Now, if you've gone, I've bought 35, I want to retire early, I'm going to buy 5 investment properties, I can borrow them at 1.99%, I've got free cash flow of 40 basis points, everyone's told me that I should accumulate wealth through real estate, and then you've woken up today and went, my $2 million worth of loans have to be refinanced at 5.5%, and my value of my properties have fallen 15%, you're in hurt. You potentially are in a point that you could go bankrupt at 35. Now, you don't have a house, you still got 2 children, your wife's back full time, and you've blown it up. And there's so many examples. That's just real estate. Everyone loves real estate, right? And I think passive investing with geared money into real estate is a really safe way, but it's a really dangerous way. Same as a geared loan or a business venture. So our job is to, in accumulation, and not saying we do it a lot, but we give general advice, is just don't make big mistakes. Think about what it looks like on a long-term perspective.
Yeah. And so the answer would be, it depends, doesn't it? If you're going to contribute to super or do it outside. Yeah. What are your other priorities that you've got? Do you have children? And if you have children, you don't want to be locking up capital there. Do you want to buy a house? I know more people don't want to buy houses. Then maybe it makes sense to start contributing. But the tax benefits, everyone knows tax benefits to super. The key, and I think the book you gave me as well, about compounding is how do you have discipline and how do you start earlier? Whether it's super or not, it's just starting, contributing. Whether you're putting it aside because you don't want to buy a house and you're investing it, or you're pushing into super, having discipline and making sure it starts.
Yeah. What does Charlie Munger say? He said compounding is very, very powerful. Don't interrupt it.
Yeah. Well, the other quote in there was you can get 50% wrong and still do incredibly well.
Yeah.
That was that Psychology of Money book.
Yeah. Morgan Housel. Yeah,
which everyone thinks you have to get everything right all the time, and we've seen that in building investment portfolios. The best fund managers get 60% right at the best times, but you can compound it 7 or 8% per annum by not getting anything significantly wrong, minimizing mistakes.
I don't know if clients do the same thing. So the only time I've been to FOSS where a client has complained about advice was once, and their client was a client for 7 years and their average return was 10.5% per year. But he happened to have a small holding, I think it was $8,000 in Centro, and he thought I should have seen a fully diversified portfolio, 40 holdings, but he wanted his capital back from Centro because I should have done the analysis to understand Centro.
Yeah. This is the shopping centre.
The Centro, Centro was one of the biggest property groups in Australia. They got caught up in the GFC, ended up collapsing. So lots of lessons there for us and for our clients. But he could not move away from the fact that he had an investment that was that went to zero, even though his compounded returns were kind of 10.5% over 5 years, and no one gets it. Even us don't get it 100% right all the time. So it's important to have diversity and not just focus on the losers, focus on the winners and focus on, your total return and your objectives.
Well, it's funny. Well, it's not funny, but inside Selfwealth, you can track the best, because over 100,000 traders, right? Investors.
Oh, yeah.
You can track and you can see through the portfolios. If you've got a premium subscription, you can see what they hold.
Oh, really?
And when I go through this list, it changes frequently. When I go through the list, it's almost always ETFs are the predominant tool used amongst those top performers. And I think that is, again, about what you're saying. It's not taking excessive risk. It's saying, I've got a diversified portfolio. If there is, if I've got a diversified ETF, that's like a property ETF, it might have 50 holdings. If one of them goes bust, so what? Like, you've still got the other 49. And that's investing.
Yeah.
Right? And that's what I think we're seeing increasingly, people building wealth inside or outside of super. They're realizing that they don't need to swing for the fences each and every month or year or check their portfolio every day.
Yep.
Which is so important. And that's why it's really great to talk to you guys, because you zoom out and you go, well, what's the vision here? What's the purpose of your investing your money? Like, what are you doing? Where are you going over the next decade, 2 decades, 3 decades? Not necessarily what are you thinking about this week?
Yeah.
Which is totally different.
I think that's 100% right. And a journey of a financial planner is probably very similar to a journey of a client. So if you came to me as an advisor 20 years ago and said, Jamie, what's page 78 of the BHP annual report? And I'll get into that detail, right? And I go, oh, look, it's intangibles. Let me make some calls. But we learn, and all the great people I had around me kind of taught me that the levers at the front of the process, which are, let's add strategy, asset allocation, risk profile, tactical, what exposures do I need, and then how to get the exposures. That's the last bit.
Yeah.
Everyone wants to talk about BHP versus NAB or NAB versus CBA. Really interesting, but that's probably not going to change the outcome over this 30 years as much as those things.
Yeah.
So we focus on those things. I think we're pretty good at the end bit as well, but those things will change. What's your risk profile? How are you allocating money? Are you just in the last wins for us in the last 18 months for clients was that we didn't hold any long duration bonds. We decided to be all variable essentially, which meant in that period of time, clients didn't lose a lot of money when bonds substantially changed.
Yeah.
And the difference probably 15%. Now, that was a strategic decision to do that. It wasn't picking...
Not a stock decision.
It wasn't a stock decision. It wasn't a fund decision. It was this kind of strategic, we don't want to be exposed to there. Similar to how we would invest globally. Where are we allocated? We went overweight growth. That helps substantially. So those decisions, which financial planners are really great at making, aren't necessarily what gets talked about all the time.
Yeah, it's not sexy, right?
No.
It's not it doesn't just peddle the news wheel every day,
Correct.
right? So we're just to recap some of the things here. So we've got potentially looking at an SMSF, self-managed super fund, for this, contributing more to super because of the tax advantaged nature, which is 15% for those of you playing along at home.
Plus some focus on education around super as well.
Absolutely, yeah. And then we've got the mortgage, which is non-deductible. So many people will say that if it's a non-tax deductible loan, do you need it? Almost questioning that.
I'm pretty conservative and would just tell you to pay it off.
Just get rid of it.
But
Probably-
keep it
Let's agree
open.
that's what would happen.
Yeah.
If there's no capital gains tax here, we'd sell the investments, we'd pay off the loan,
Yep.
and then we might start a savings plan, ETFs outside, or
And then you've got the credit card, which would just be knocked straight on its head, I'm assuming. Yeah.
Yep.
sure.
Some people do. It's fair to say the counterpoint is some people do use credit cards for points and they do all that. I always get I'm more risk adverse. I say just get rid of it personally. But,
I would keep it. It's just the balance seems to be excessive to what they say they're spending.
Yeah, because they're saying that it's.
Could have been a holiday, could have been something, but that's a red flag. If you're sending 6 and you got a monthly credit card bill of 18, and then it's the biggest fruit, like it's the worst type of debt, ongoing
probably
debt.
20%
Sure.
interest on that thing.
Yeah,
Right?
at least,
Yeah.
Check out the car loan interest as well.
Yeah,
so
55 grand.
if they have got room on their mortgage, maybe they can, hire purchase seems to be the best way to buy a car depending on their circumstances. So maybe you can go to your bank and say, I want to borrow that 55 at my mortgage rate, a couple percent, versus what their car loan is. But again, we don't have the details. So
Okay. So we've got, as a general, you would also probably, I think, Drew, you've talked about, did you call it, not a reverse budget? Is that what you called it, a reverse budget?
This is my old, I just look at what's in my offset account from one year to the next and work out how much I've saved.
Yeah, even when you have
spent.
clients come in, a retrospective budget, that's what you call it, not a reverse budget,
Yeah,
a
I think
retrospective budget.
The problem that I think everyone, young and old, have is they sit down and write a budget and say, this is what I'm going to do this year. But that requires a significant change in the person that you are or your habits. So you can't plan for a change in habits. You have to look at what you did last year. Potentially you can, there's probably areas of, call it fat or flab that you can take out.
Yeah.
But it has to be forward-looking at what you've actually been spending and adjusting for that. There's no point saying this is what I'll
start
spend
with
every
fat
time.
first, right?
And then work from there.
Yeah.
We had a client that sent us the most detailed backward budget and then had applied some changes to that going forward. Right. And that was, we tried to offer him a job, but he didn't want to take the job. It was the most insightful budget I've ever seen. So.
We had a client that ran all his personal finances on MyOb, and then he would come back and say, okay, this is what we spent, this is what you earned me, this is our P&L, this is what it looks like, so every expense. So anyway, we're not
it's a full spectrum.
$2 in the ashtray in the car.
Right.
But I guess that's
It's
a great way to start. So we've got the super, which is the asset pool. We've got the house and the mortgage. Then there's the budgeting, or like the cash flow, the free cash flow Jamie mentioned before, which is, and to using Drew's idea, is like a retrospective budget looking backwards to say, is it actually the case? Like, did it actually make sense? And let's look forward now. How about, Jamie, just with the house here, 1.5 mil, that's the rough estimate, say, of Ashmore. I'm assuming it's a nice place. Would they have to sell the house to afford a good retirement?
Yeah, I think that people forget the value of their house within their financial planning. So total value of the client is always looked at, and how much are you putting into lifestyle, and how much you're putting in investment assets is a really important split. Now, there's no right nor wrong, especially how real estate is done over the last 15 years. And we have clients that have 85% in lifestyle and 15% in investment assets, and they feel really comfortable with that because at some point they'll sell down one of their lifestyle assets.
So like a beach house or something like
Yeah,
that.
so typically it's a house and a beach house, and most people can't afford a house and a beach house. So rather than running a $2 million portfolio, you might run a $500,000 portfolio, which once you draw it down, that'll take 8 or 9 years, but you get to spend 8 or 9 years in a beach house, which could be like a family compound as well for your children, your grandchildren, and your house. And then at some point you either choose to sell your house or your beach house and you repopulate the portfolio.
Yep.
Legislation is helping us with that as well.
A 4-bedroom house becomes big for 2 people
it does.
as well.
Average value of a house in Australia is probably, I don't know the stats, but I'm guessing it's about $800,000.
Mm-hmm.
They've got a house that's worth twice that. So probably in that second stage or that third stage, the house would essentially be sold down. What we haven't talked about is how we would structure investments in retirement. Really important if you're drawing an income stream out of your portfolio, that you have a cash buffer. So if you think about market volatility, and that's why we want to educate our clients, because typically people do silly things at the wrong time, is that you want $80,000 a year, and probably if you have $2 million, you can get that. Maybe at the moment if you have 1.7 or 1.6, if you think about where cash rates are, term deposits, Aussie markets probably yielding 5 and a bit, 5 and a quarter, global markets yielding 2.
It's more achievable now than it was 12 months ago.
Yeah. So we talked about 60-40 being dead last year, but it's not now. It's back.
So that's
in the life
40% bonds, 60% stocks, basically.
Yeah. But you need a cash buffer, and the cash buffer is the most important thing. So so your portfolio is probably producing, close to what these people want. But in a downturn, you might get values of your portfolio fall for 1 year, 2 years, 3 years, and you don't want to sell depressed assets through that period of time. You want to hold those assets or change them to other assets that will grow when markets recover. So your income from your portfolio, let's say we did start at 80 grand and it fell down to 60 for a period of time. So you've got 3/4 of your income, you need to find that extra 20. So if you've got a cash buffer that's equal to a certain amount of years, we find most clients are comfortable with a cash buffer of that gap of between 6 and 9 years.
Right. So if it was, say, 60 to 80, that's 20.
20, yep. So
180.
180 grand. And you explain that to people. So psychological, 180 grand is sitting here just in case we fall and we've got to top up. So don't worry about the fall in the value of your assets or the income. Because if you think about the income, I think on historical analysis has taken maximum 9 years to get back from where it was to where it was on a diversified portfolio. So if you're saying, hey, you've got a contingency to market falling, you suddenly make your client a lot more comfortable. And then if they've bought an investment at $1 and it's 85 cents, they know that that's still producing income. The income will grow over time, and then they can take their money from a cash buffer.
Yep.
And this is what we discussed in part 1, I think, too.
Yeah.
Is that that gives you the emotional comfort and sleep at night. But then it also becomes incredibly important the type of investments you're holding, because cash, not everyone's comfortable just in cash. They feel like they have to spend it or do something with it.
So we hide it.
Yeah. we say hiding it in their own portfolios, of course. And that's where your fixed income and your defensive alternatives and how you define those assets. You don't want them to fall like the share market falls. You don't want them to have any level of volatility, anything like that, because you want to be able to sell them for the same dollar when you need them to fund your lifestyle.
Yeah, I think a lot of people take this for granted, the old recency bias, last 20 years, right?
Yeah.
You look at, say, like one of the most popular ETFs, which is the IVV S&P 500 ETF. People seem to have grown accustomed to that just going up every year.
Yeah.
But they could go 5 years or longer sideways.
Yeah.
Right?
And you've had markets, so the Japanese market went sideways for a decade.
Sure.
ASX.
Or expect, early 7s, 2007, we're 2022, it's
still below that level.
Yeah.
Yeah. So
people don't talk about that, right?
Yeah. But that's also why income is so important too.
Yeah.
So for a retiree, we would say don't chase income. I know this is an income podcast, but don't chase income to the point where it affects your growth. So simple equation, total return equals income plus growth. And really important for a retiree, they're going to last for 30 years that they want the growth. So you could build a portfolio today that yields a lot more than 4%. So it could yield 6, 7, 8. You're picking some weird and wonderful investments, some, mortgages on some land in some you're getting 9%, which is guaranteed apparently. You're picking all your high yielding shares, you're picking property trusts, which are leveraged to the nth degree, and you take enormous amount of risk on the G to get the I.
Yeah.
And that's that balance. Total return equals income plus growth. And what we've found, if you pull from one, you put one up, you typically pull the other one down. So a lot of income portfolios we've seen and income products we've seen actually, if you think about the value of them, the value goes down, the income comes up, and guess what the total return is of income plus growth? It's the same as if you had a balanced portfolio anyway. Yeah. So we strive for really good income, but we're always really careful of value traps and things that are too good to be true. Yeah. So that balance is important.
That's the biggest mistake we talked about, which was don't just look at headline income.
Yeah, there's a few funds on the ASX that like some products that are designed for income, but then you just look at the share price, the things just going to nothing.
So this is back to your question about what should they do with their house.
Yeah.
You know, I would feel more comfortable for them achieving their objectives in a much easier way from an investment perspective and a psychological perspective if they sold down their house and they had $2 million to achieve $80,000. If they had $1.5 million, then suddenly there's a tendency for us to start
taking more risk.
Yeah, pushing up that I, risking the G, and so it's not a wrong decision to do that. It's just make sure you understand the outcomes and the ramifications of your decisions and what you need to do. You know, at a $1.5 million portfolio rather than $2 million, you need to be more educated. You need to, when we say move into markets because they're depressed, you need to move into markets because they're depressed. When we go, hey, sell your tech, you need to sell your tech. You know, you need to listen. You need to move quicker because you've got less capital and it's more sensitive to the decisions that you make. So you need to be a better investor.
They're probably later starters than a lot, which is actually becoming more common. So if you look at how old their kids are, they had children in early 40s. I know it's more common now, but we talked about the peak saving years comes in your 50s. That generally is when you're having children in your early 30s. So it's kind of pushed that back, and you'd probably say if they're saving 100,000 at the moment and they're at 1.1, they actually need an extra 4 or 5 years of that savings to maximise the probability of getting to 2 million outside of the additional things that they can do to achieve that.
Yeah,
which is
our old business partner, Ian Murdoch, would always talk about pin money in retirement too.
Pin money?
Yeah. So there's this opportunity for pinballs, for the pinball machine. So what can you do in retirement? So if you
there's a free
So if you went and got a job, whatever it might be, for 1 day a week from 65 to 75, and you're earning, $8,000 a year, $10,000 a year, what's the capital you would need extra to do that? You'd need another couple $100,000.
Yeah.
So, this kind of part-time, Bunnings is a perfect example, right? So lots of tradies get bored. 2 days of Bunnings probably gives 15 to 20 grand in their back pocket. That's pretty powerful.
Absolutely.
When you think about retirement, it's even more powerful if you talked about the age pension, which we don't a lot. But, that pin money concept is a really interesting one because retirement doesn't have to be off or on, which we all think it is. Today is my retired and tomorrow I'm going to do something different.
Shouldn't be.
Yeah. It's such a good point. Like the human capital there, when you get to the stage as well.
Oh, it's important for the economy, isn't it?
Yeah, absolutely it is. And not to get too far into the weeds, but it's also shown that if you do work in retirement, it's actually much better for your mental health. Gives you a sense of purpose, at least for a little while, maybe only 1 or 2 days a week, or giving back, or whatever you want to do. Well, guys, so I would just maybe conclude with one very simple question, and I might ask each of you to do this. It seems like the answer is yes, but Drew, do you think Cathie and Wood here could retire and meet their $80,000 goal if they were advised?
I think they can, but a very big focus on minimising mistakes and making sure they don't get anything wrong.
Yep. Jamie?
Yeah, I think there's a lot to work through. I've said it throughout the podcast. They seem to have the right assets to achieve what they want to achieve as long as they make the right decisions.
Yeah,
but clearly would benefit from advice without blowing our own trumpets. But there's a bit of complexity. There's a lot of options available. So that is the key.
Well, that's good. How do you justify financial planning fees, right? Because people go, well, why would you charge? So, I would always say it's really easy. I sleep well at night because I just have to stop you from making one mistake throughout the years and my fees are covered. Or give you one good idea just once a year and my fees are covered.
And that mistake could just be not using super enough.
Yeah.
Like just convincing Cathie to use more super could save her hundreds of thousands of dollars.
Yeah.
So then our advice is free after that. That's how I see it, because you're talking about substantial amounts of money. You're talking about finite capital. You're talking about their life. So to engage a competent financial planner at a fee, the equation of the value they add should be so simple. It's not funny.
Yeah, I think a lot of people don't think like that, but they should, because as you approach retirement, you've got a much larger balance. That's fantastic, but it also means there's downside from one small mistake.
Yeah,
that could turn into a big mistake.
Well, if I go back to my life cycle of a typical person, and why financial planning fees could be so confronting is typically you haven't seen, if you've worked with for people, not for yourself, you haven't necessarily written a check for professional service advice before. So and we don't hide any of our fees, right? We're not getting kickbacks from anywhere. So we're saying for us to run a comprehensive financial planning firm with a research department, with dedication to you, it is going to, and we run our business fairly, e.g. we make an amount that I think is economically fair, so we're not making 70 or 80% margins on our business, we're making a fair margin, then that will cost you a check of $3,000 a quarter. That's very confronting for people, because people go, $3,000, I could put in, I could repaint the back room for $3,000. But you've got such a big pool of capital, then you need to see it through a different light. And that's the biggest challenge we have with clients that come to us, and then clients that go to other groups that would hide half their fees, that it's just people want transparency, but then that means
then the bill comes.
Yeah, that mean goes, well, hang on, what does that mean? What did Jamie do for me this quarter? He was on a podcast.
No, it's fair. So I'm a huge advocate of people getting advice, particularly at this stage of life, which is why we put it here. But also people in the Selfwealth Live community said they wanted us to talk about passive income and retirement, the two most important things in their life.
Yeah.
And they're not, they're not separate items, they're together. And I think this episode is going to help them. Please read the case study if you haven't, if you're just catching up. The case study, you can probably read it and go back and listen or watch this again, because there'll be things that you may have missed like I have. So this has been a lot of fun, guys. I really appreciate you taking the time to come on. If people want to get in touch, they can head to wattlepartners.com.au/contact. There's a form there that they can fill in. I know a lot of us in the community have reached out to Jamie and Drew and the team. So I'll just say let's be a little bit patient, because there's been a lot of people reach out and get in contact, which is great. And don't forget, on Selfwealth Live, we go live every week. We'll be back next week, where we will be answering your questions live. These are obviously pre-recorded here in the studio, but we will be coming to you live, maybe from different parts of the country. This might be the one time we're together, and then we'll be totally separate. But we will be answering your questions live, so please come with those locked and loaded. I will say, when you do ask your question of us on the night, there's going to be a lot of questions coming in. Please just remember that we can only give general financial information in these shows. We cannot give personal advice. As you've heard today, it gets quite complex. But as long as you tailor your question appropriately and you make it general in nature, we should be able to have a good crack at it and hopefully help you on your journey. Guys, we've covered a lot today. Jamie,
as always.
Yes, we have. Jamie, I'll start with you to say thanks, mate. You've done a great job. First time on Selfwealth Live. Really appreciate it.
Thanks for the case study that was relatively easy.
Yeah, well, I'll leave it up to the community to ask the curveballs. But I appreciate it, mate. And,
no problem.
And Drew, as always, mate, thanks for taking the time to